You can't get much bigger than Bill Gross. He is, of course, manager of the world's biggest bond fund. He has made it very clear, very publicly, that he believes treasuries are a terrible investment. But until now, he hasn't weighed in as forcefully on equities. And it turns out Bill Gross doesn't see much in stocks either. He did speak here yesterday, as you mentioned, at this Morningstar investment conference. Listen to what he had to say.
Perhaps if there was a growth or a productivity miracle like the dot-coms in the late 90s, but absent that, the dominant influence on a PE ratio is the real interest rate. And if it's not going much lower, then PEs aren't expanding much, nor are cap rates on commercial real estate going down much, which basically limits the price appreciation in terms of commercial real estate. And again, back to the example in terms of housing prices.
So if treasuries are a bad investment and stocks are little to no better, what do you do? Bill Gross has some advice there as well.
You must get outside the United States, or else 10, 20, 30 years from now, and aside from what might happen here on a fiscal basis in terms of how we resolve this crisis, which itself, of course, is inflationary and threatening from the standpoint of debt levels, I can say with greater than 50% certainty that your pocket relative to inflation will have been picked if you stayed here.
What the Fed does next is anyone's guess, isn't it? If anything, though, we know better what the Fed won't do. Ben Bernanke, the chairman, made it clear just 2 days ago, don't expect another round of monetary stimulus or QE3. So the question then is, how does the Fed keep Treasury yields from rising and derailing the economy? Well, Pimco's Bill Gross has an idea, and he shared it with the crowd right here at the Morningstar Investment Conference in Chicago yesterday.
What I think the Fed will do is basically to keep yields relatively low via language. And language is an important signal. Janet Yellen has basically been assigned the task of communicating, and yes, it's come out in the form of Bernanke's press conference, and we've focused on that, and that has been one of our assignments. But another assignment, I'm sure, I don't know, but another assignment, I'm sure, has been how to communicate going forward this extended period of time, and in fact how long the Fed will rest at 25 basis points. If the Fed stayed at 25 basis points for a long time, and let's stretch it just to make the example, if they stayed at 25 basis points for 2 years, for 3 years, for 4 years, for 5 years, let's just go there. It's not our forecast, but let's just mentally go there. If they, in some form or fashion, produced language that gave investors the comfort that 25 basis points would be the standard for the next 5 years, then a 5-year Treasury at 1.5% would be a steal. Even Pimco would rush out and buy them because it would be better than 25 basis points, and it would be better than the 10 and 5 basis points offered in the 3 to 6 month Treasury bill market. So the language will be the new QE3. To my way of thinking, there won't be a purchase program. That's over and done with, except for the $15 billion a month from mortgage repayments. But the language will be critical, and I would look for the extended period of time to be emphasized over and over and over again. And certainly with unemployment at 9.1% and a gap in terms of the economy and employment so substantial that, at least to the Fed's way of thinking, it's non-inflationary. So that's a magical weapon that they can keep real interest rates down at these levels without having to find a buyer for basically $850 billion worth of treasuries that the Fed is now buying and won't be buying at the end of June 30th. So who will buy them? Perhaps banks would buy them. They haven't been big buyers in the past few months, but perhaps knowing that Fed funds would not move, they would buy one or buy some. Hedge funds would buy some, and even, like I said, even Pimco, if we had the certainty of a long period of time, who wouldn't buy them because it would be better than the alternative?
Bill Gross also compared Treasury investors to a frog, or frogs, in pots of slowly boiling water. Say they are, quote, getting cooked.